Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Lori Calvasina said she wouldn't come on if I didn't do bear market, bull market calls. I got to do standard deviation calls. And we're out at 3.3 standard deviations down. Standard & Poor's 500, one step down, two steps down, and this morning, 3 steps down. We are honored that Lori Calvasina would join us here in this hour. Again, commercial free at Nationwide. Lori, your observation as you speak to your clients this morning.
So look, I think people are trying to make sense of what's going on, how far we could go down. Just a few minutes ago, I had an email with someone who was talking to me about my 4 tiers of fear framework and said there's a lot of sympathy among my clients for your 3100, which is the 4th tier, where you have a major crisis and lose half the market value. I'm not going to sit here, Tom, and tell you everybody's saying that, but that was one email that came across.
Right.
Whereas other people have sort of resonated to the idea that we said, we've been in a growth scare. The risk now is we're pricing in recession. And it sounds to me like just based on where we open, we're headed straight for that. So I think that people are doing what we do when we have these events in markets where there
Right.
is a fear that is cascading very rapidly.
What we're going to do here now with an equity strategist is take all of her wonderful abilities, particularly with less profitable non-Apple, non-Microsoft companies, and bring it over to what people are talking about with the Dow negative 1,400. Lori Calvasina, take the equity market and what it will bounce off in a credit market that deteriorates. The jargon that Paul Sweeney uses is spreads deteriorate. That's the yield of a garbage bond versus a full faith in credit, and the yield goes higher. Are we at a tipping point in credit that affects the equity market?
It's a great question. I'm certainly not an expert on the credit market, Tom, so I'm gonna deflect on that one. But what I will say is that, maybe up until about a week ago, and it was a little bit before the Rose Garden ceremony, to be honest, but we had actually been seeing small caps starting to outperform large caps. And like on the big down days in the market, small caps weren't doing quite as bad. And I thought that was interesting. That was making me feel a little bit better because they had already been so de-risked. They were so cheap. And we felt like there was this rotation going on that was hitting the bigger caps harder than the small caps. But that's all changed. So we've seen that attempt that small caps were making to bottom now fail post the Rose Garden. And that's going to be very, similar, right, to that high yield cohort of the market. And what that's been telling me over the past few days is that those recession risks are getting priced in rapidly because as cheap as they are, and honestly, Tom, my valuation PE for my valuation model, the market cap weighted PE for the Russell 2000 was at 13.5 times on the Thursday close. In a recession, it tends to go to 11 to 13 times, even before you clean up the excess earnings optimism. So these things have been acting pretty bad. But
Right.
I do think that credit markets holding up, not deteriorating, that's been sort of the thing that's kind of kept people out. And I hate to use the word panic in markets like these, but that's been kind of the thing that's kept people calm. But that may be a necessary part of the bottoming process we have to go through in here.
Let me uncalm you right now. Paul, the VIX 52.07.
Exactly. Lori, what's the earnings risk still out there in the marketplace, do you think? I mean, is it a flat earnings year in 25 or maybe something more than that?
What we've got modeled is kind of a stagflationary scenario right now for 258, which is well below the bottom up consensus, which last I checked was 269. Who knows what it is now because things are starting to change. But what we have found is an interesting question you asked, Paul, because if you kind of go back and look at bad earnings years, what we often find is that in kind of big crises, big recessions, you're seeing earnings growth on a year-over-year basis going down like 13% or something worse, right? So some big ugly numbers. But there are actually a lot of years where earnings are just flat year to year. And when we see companies, sort of being able to muddle through, that's often what's happened. So when we recently changed our earnings number to 258, we said, kind of the downside scenario, if we want to kind of put in a bear case, we're thinking a lot about kind of that 246 number for now. That could change if we go into a full-on recession.
Yeah.
But outside of that's not a bad assumption to make, just that earnings go nowhere.
Lori, I think most of us listening, watching here would say, you know what, 12, 24, 36 months from now, this market's going to be higher than where we are right here, probably meaningfully higher. So I should probably be doing some buying here. How does that conversation go with you?
Well, look, I'll tell you, it's sort of the fly in the ointment for the strategists right now. And I see this in my own modeling, Paul. We have 5 different models that we use to come up with our price targets. And I know everything is scary and people are like, math, oh my God, you're doing math. But that's what we have to do, right, to keep ourselves grounded. And when I go through and look at my modeling, the one model that's still pretty constructive is actually the sentiment model. And it's basically looking at AAII net bulls that are down around GFC lows, 2022 lows, 1990 91 recession lows. And that is a good reminder that as quickly as things cascade onto the downside, they tend to come roaring back when you get some resolution. And so I think that's, that's something a lot of, us forecasters have had in the back of our heads as we've tried to navigate this environment. It's hard. It's not impossible, right, to say what is that trigger, but it is something we have to watch, and it's a necessary condition for a bottom that's already been put in place.
Tesla, not to a 200, 199. We're not there yet. I don't want to be too gloomy, but I'm going to go over here, Lori, to something nobody talks about. And of course, we're on a Canadian border on this. Ford Motor under $10, $9.11, right down on lows for 2025. And I got a PE multiple on Ford of 5. And maybe the forward multiple, which we're going to blow up, we know that, is 7. Are we in value territory in medium and small cap stocks like we clearly are with the Ford Motor Company?
So, I was having an argument with someone about that this morning, Tom.
Not your husband.
I was talking about, not my husband.
Okay.
I'm on a trip. I'm in a hotel room. So believe me, he argues with me about plenty of things.
The marriage survives.
Yeah, but not. He's very scared of my tears of fear chart. I had to take some passwords away from him. But the reality is that when I highlight this small cap chart and that we're at 13 times, or at least we were as of Thursday, people say, well, we have to adjust the earnings, and I say, I know we have to adjust the earnings. That's a separate thing, though. If you look at sort of historically my forward PE data, 11 to 13 times is where small caps tend to bottom out, even when the E is too high, and people just can't mentally wrap their heads around that. But it is something important you have to keep in mind, because it's one of those things, again, that you have to see. Right. It's not going to peg a bottom on its own, but it's still a signal, even though there's some problems with the E. Now, I do think with earnings, we have to get the numbers down before anybody is going to have faith to come in and buy here. 40% of the revisions in the both the Russell and S&P are still to the upside. Nobody's cutting numbers because they don't, I don't know, a lot of different reasons, but nobody's been cutting the numbers.
You're a trooper to come on. Lori, back to our clients at RBC Capital Markets. Lori Calvasina, or hug the children is all I can say.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I had a major industry heavyweight who sent me his internal memo for his company. And he said, Tom, you can't mention my name. You can't mention the note. It's, compliance and all that. But his analog was 1998. What is Michael Purves's analog to where we are right now?
Well, that's when Paul and I were working on telecom M&A in corporate finance. There, that was a long time ago. There, I'm not sure what your friend was referencing exactly.
August of '98. The upset of August of '98.
Okay. Oh, I see. Yeah, that part of '98. Okay.
Capital manager.
Yeah.
Right. Yeah. Well,
not the Red Sox of '98.
I'm not sure I completely connect those dots in my mind right now. I mean, that was a very sort of micro thing. This is when what's the problem? If we go back to the last two big events, COVID and the great financial crisis, those were giant left tail shocks. The federal government was there, in whether it's monetary policy or fiscal policy, there to be the ointment, the salve for getting the wounds repaired and the economy back on track. In this case, the federal government is actually the catalyst for the volatility. So it's a very different, I think, mindset here. I think it's a very uncharted waters here. I think coming in before last Wednesday, I've been conditioning clients to think about 4,800. not on an economic bear case, not on a recession, not on something ugly, just simply normalization of valuation and a little bit of earnings slippage, which is sort of normal course of business. And I think where I'm at, Tom, right now is that, this is not like an official price target, but I think investors have to have their minds open to the fact that 4,000 is not really as crazy as it sounds. Wow. Think about it. You could get even 3-handle S&P 5, like under 4,000, 17 times flat earnings growth, 17 times. 17 is not some super distressed price, and flat earnings growth is not really that big a bear case, right? If you have some margin slippage and you have some top line slippage from where analysts are. An overarching point I was trying to make in my note yesterday, Tom, was that, you know, the pivot from and sentiment, the feeling you have is absolutely shocking, right? The reversal there, but the absolute levels of where things have been is still really high compared to where we were in March of 2020 or during the Lehman Brothers saga and so forth. And I think, you know, you look at credit spreads, those were backing up hard last week. Look at a 10-year chart of those credit spreads, right? Look at a lot of cross-asset volatility metrics. You know, for example, the Korean won volatilities that Damian Sassower looks at all day long, right? Those really weren't moving up at all last week. They are starting to now, right? If you look at one of the other metrics I think was really interesting is that, of course, the VIX had soared and it's still soaring. If you looked at other European equity vol, Nikkei equity vol, that had gone up, but the spreads between US equity vol and European equity vol or whatever was at record wise as of Friday.
On a PE basis, and I take your point on compression with earnings coming down. You mentioned Paul Van Ives. Given a Tesla change here. Is it enough of an earnings compression where you just directly link it to a greater economy that's going to be destroyed by tariffs? Because if the academics tell me the people from Columbia, if you go to Columbia, you get an ear. Did you study with Mundell? Were you in a classroom with Robert
I was
Mundell?
an architecture major at Columbia, so
I was far economics as a minor,
far
right?
From that. Not a minute. No, I studied.
Well, maybe that's why you're so good. Anyways,
I did in business school though, but yeah.
The bottom line is earnings come in because the economy comes in.
Yeah.
And the answer is every academic note I see. Good morning, Maurice Obsfeld out at Berkeley. Is the GDP is going to come in real or nominal? Do you model that?
Yeah, look, I think you have to. It's very hard to model what the nominal GDP.
Direction, vector.
But also with earnings, right? If you look at what is implied, you look at Bloomberg consensus, top line for the S&P 500 and the bottom line for this year, next year, implied are margins that we've never seen before, right? Really high margins. So a little bit of margin slippage without Liberation Day should be expected, right? A little bit of, obviously tech margins have been a great story there, but a little bit of margin give back, I think, should happen if nominal GDP contracts and if companies are having a harder time selling their products and services into perhaps a overstretched consumer. Now you have to bring in maybe a bigger story if these tariffs really start denting margins, and that's how you can get. You don't need a recession to get flat earnings growth in 25 and 26.
And now, folks, the Surveillance Audible. Paul, did you ever confront this? Like when you were writing reports, the macro shifts, and you've got to readjust your spreadsheets and the 2 pages you're writing in front of it?
Yeah, absolutely. Particularly with the media companies.
Are you doing it because you're doing it, or your compliance is telling you to do it?
My companies are driven by advertising, which is very cyclical, so it's easy to model that. But I mean, I'm just looking at the S&P 500. The street, Michael, still got 10% earnings growth this year, 12, 13% next year. Numbers got to come down.
Right.
Do you have a recession in your model? Is that
No, I don't.
Okay.
I don't. And to be clear, I'm not an economist. I don't look at it, but I do look at economic data all day long, and I do look at where more importantly, where the sort of the consensus estimates are, and so forth. And those numbers, I think a lot of analysts, whether they're stock analysts or economists, the ones that are surveyed by Bloomberg in these surveys, they can, you have to recognize that, look, it's hard. They didn't have inputs until Wednesday, and the inputs that they now have are very confusing and very dynamic.
And I would suggest, Paul, jump in here, but I would suggest, Paul, that they haven't had time to publish. Everything Michael's talking about
so quickly, you're right.
is late this week if you're lucky.
Right. Yeah, exactly. So what do you expect to hear from companies this earnings period? Boy, I don't know. I don't know how to write that script.
Okay, so if you were advising the CFO and the CEO of one of your former clients, right, what would you do? You'd be probably say, let's guide down. We have a good, like that. And look, and maybe if all this thing does, I don't want to sound super bearish here, but there is a bull case that if the C-suite guides down and says, look, there's so much uncertainty, we're just going to be very, very conservative here, and we get through this tariff stuff, and the good things happen in the second half and into 26, there'll be a lot of upside there, and from the consumer as well, right? Like if the consumers are getting conservative, that preserves their balance sheet to spend later, right? So there is a bull scenario there that you have to consider, but I think people are going to guide down. Why wouldn't you guide down really hard
here?
And,
Thank you so much on the Pacific Rim in their evening. This is a lovely lady from Shanghai emailing in, Mr. Purves, when do I buy the dip?
Well, I think there's more downside coming. One thing to think about is look at long-term momentum signals, right? Like I look at the monthly MACD on the S&P 500, that has just last week turned a key point, and it's exactly like what happened in March of 22 when we went into a bear market there. I don't think dip buyers are coming in anytime soon. I think the clarity, this uncertainty cloud is not going away. People talk about the Trump put, and my point back to them is that the Trump put is not a Fed put, because the process by which that unfolds, what's the strike price? When do we get there? And all that kind of stuff are big questions. Will we ever get there? Right? Is another broader question. But if let's assume a bull case here that we get sometime later this quarter we get a very clear set of policy. It's asymmetric. That doesn't mean that the certainty comes back as quickly as it disappeared. Tariffs are it's a weapon that Trump is using that is to realign the industrial policy of the United States, but it can create a lot of damage. Repairing the damage is a slower process.
Paul, Purves is a threat to society. Get one more question in here, but futures now just ticking negative 1,000, negative 1,047 on the Dow, the NASDAQ negative 2.8%. This is all Michael Purves is doing.
Exactly. The RSI, the Relative Strength Index for the S&P 500, we're now at 23.
Yeah.
That's below that 30 level, which is historically a technical buy signal.
Oh yeah, no, and to this person's question, I mean, from a very near-term trading point of view, I would expect a bounce here this week. Absolutely, 23 is pretty extreme there, and then you got to watch what kind of selling pressure comes into that bounce and so forth, and how it reacts to other news flow as well. But I think valuations and earnings, buying a dip on a strategic basis before the earnings season is a very tricky thing, and earnings are just going to start coming in.
Michael, thank you so much. Michael Purves, Tallbacken this morning.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Henrietta Trey's now Veda Partners. Maya McGinnis later on the debt and the deficit. Henrietta, I want to go to one of the most interesting politicians, whatever you think of him, in Washington, Mr. Cruz of Texas. He's got a mathematics whiz mom out of Rice University. His father is a stereotype, came over on a boat from Cuba. Ted Cruz is different. He's had it with the tariffs. He wants free trade. Does he have any company this morning in the United States Senate?
There are about 6 Republican senators who are willing to sign on to a bill that after 60 days might consider thinking about taking back some of President Trump's authority on tariffs. So a lot of this is a little bit performative. If you'll excuse me, he had an opportunity to vote against just the Canada tariffs, our largest trading partner, 4 days ago. And he did not support that measure. So there's a lot more that we need to hear.
Explain to Republicans, Democrats, Independents, John Tucker, explain Henrietta Trey's how they can mouth off how they're against the president, but at the same time they voted against the Toronto Maple Leafs. It's unbelievable. How does this happen?
It is a full course change for the Republican Party from a decade ago. This is not your grandfather's Republican Party. These are not free traders. They believe there's no such thing as free trade anymore. There's only such thing as fair trade, which apparently is the reciprocal tariffs that put, nearly 100% tariffs on goods coming in from China and 40% plus tariffs on Canada and Mexico, our largest trading partners, 25% tariffs on EU automobiles. That is what they consider now free and fair trade. And they have an opportunity to, if they really want to make a splash here, get in front of Jamieson Greer on Tuesday when he's in front of the Senate explaining the president's trade agenda. So watch that if you want to see something performative instead of, just a couple press briefings or tweets. You got to get out there and really do it. Otherwise, they're not going to move the president off of this.
Okay, so Henrietta, just to be clear here, folks in the market should not expect Congress to step in and slow down or alter or push back on these tariffs going forward. Is that the message?
That is definitely my message. Okay. And I would get more specific if you don't believe me. They have 4 days. They have tonight, Tuesday, Wednesday, and Thursday, and then they're gone for the rest of the month.
Oh boy.
So a month in the markets right now is an eternity, and they will be out of town beginning Thursday night. So that's your limit.
Okay. All right. I don't even know why they're out of town. The rest of us are working, so I'm not even going to ask that question. But what is next on the to-do list for Congress that the markets need to be focused on?
Well, the market is very optimistic, I think way overly so, that we're going to get some sort of stimulus to combat the trillions of dollars worth of tariffs that have taken hold in the market and are roiling the global economy. The bill that the Senate has passed, the budget that they've passed, authorizes $5.3 trillion in deficit increases. And in the stimulative components there, I can count about $300 billion worth of available funds to do maybe a little bit of things like eliminating taxes on tips, which is $175 billion, or half of the available basket of money that they can spend for fresh stimulus. So we're going to spend the rest of the summer working on a massive tax bill with substantial deficit increases that don't stimulate the economy.
Folks, I'll just editorialize. I don't know how you do a quote-unquote massive tax bill with a VIX at 48.47. That's original. Henrietta Trays, to cut to the chase, and I look at Charlie Cook's Cook Political Report, the Cook Partisan Voting Index, of 435 Congresses and 1/3 of the Senate. Has Mr. Trump lost the Republicans, the House and the Senate?
I would say certainly the House. The average change for this president and other swings of this magnitude is a loss of between 40 and 60 seats in the House. That's in a situation where the Republican conference only has the margin of a couple. Right. 40 to 60 is a seat change. Who you want to hear from is not Ted Cruz. You want to hear from the members who are up in the Senate: Susan Collins, Tom Tillis, and those guys. See where they are.
Okay, well, where's Tom Tillis on this? I mean, the gentlelady from Maine is on the Canadian border. I get it, okay? Tillis is from what, the Carolinas?
Yeah, and Senator Tillis is amazing on this. He's actually getting out there in front of some of this legislation and signing his name on the dotted line, saying we need to claw back some of this authority. North Carolina is a purple state, and they support the Inflation Reduction Act. They have a ton of jobs coming in from all those clean energy manufacturing tax credits. This is an educated voter base. Senator Tillis has the opportunity, and I think is taking it to be at the forefront here.
Is Grassley of Iowa on board with Tillis?
Yeah, Senator Grassley is the original sponsor of the legislation. So yes, absolutely.
Can you be with us
tomorrow? But not enough so to stop this.
Henrietta, can you be with us tomorrow? Can we do a remote from Ben's Chili Bowl?
Oh, sure. I can do that.
Okay.
What time?
Henrietta Trays, U Street tomorrow, NW. Thank you so much, Veda Partners.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What we're really trying to do here, folks, is lose the punditry. There's really well-meaning people out there. Their job description is to say, catch the falling knife, here's the bottom. We're not doing that. We're trying to give you sensible talk. This weekend, I did Maurice Obstfeld of Berkeley, working with Adam Posen at the Peterson Institute, a terrific balanced essay of core economics. We do that now with Keith Lerner. Can't say enough about his work with Truest a long track record of being measured and providing perspective. Keith, what do you say to people now who simply say, should I go to cash?
Yeah, well, first, great to be with you. It's always good to be on with you all. So our main simple message today is it's time to start thinking about two-way risk, not just the downside risk, but also the upside risk. Back in February, when we were at all-time highs, there was a lot of complacency. We actually downgraded equities back then. We've had this sharp move lower, Tom, and we've had a historical move lower. So again, time frames matter. Every individual circumstance matters. But our main message is, if you have a goal and you have, the wherewithal to go through this, we would not be selling into this weakness. And we can talk about this. We just published a paper going through some statistics as a guide about how things tend to act after these brutal two-day periods that we just saw.
Do you dollar cost average in?
Yes, I think that is a prudent approach because there has been some damage, right? Things have been broken. We are not going back to new highs anytime soon. At least our work suggests that to be the case. What also happens after we have these really sharp two-day moves in the market, what's notable in our work is the sharp two-day up moves tend to happen within the next 2 or 3 weeks as well. So you're going to see these swings back and forth. Each headline is going to be over extrapolated and there's going to be a lot of emotion. So to your point, I think using a prudent dollar cost average approach into the market, it makes a lot of sense right here.
Keith, where does fixed income fit into the discussion these days? I'm looking at the 2-year Treasury, 3.62%.
Yeah, so our main focus this year was high quality bonds are back, and they're going to start acting like balanced portfolios after they hadn't the last few years. That has happened, and what's also notable, if you're going back to just common sense, basic diversification, a 60-40 portfolio is down less than 40% because bonds have acted like bonds again as stability and income. That said, on a short-term basis, we saw bonds move from 480 down below 375. Now we're back above 4. I think, short-term, we've probably ongoing a lot lower here in the near term. But again, from a portfolio diversification standpoint, plain old fixed income still is attractive. And incrementally, we've been really negative on credit. And incrementally, we're becoming a bit more positive as those yields or those credit spreads start to blow out a bit.
I haven't asked this question all morning. I think we should inflict Keith Lerner with it. Keith Lerner, is Mag 7 the same old Mag 7, or is it a new Mag 7?
It's funny because it was FANG a couple of years ago, then it's the Mag 7. So maybe the Mag 7 components change as well. But, one thing I found interesting as I'm going through, hundreds and hundreds of charts over the weekend with my team, the technology sector as a whole, the valuation levels are now back to where they were in October of 2023. And the Mag 7, stocks have moved from well above 30 to somewhere in the early 20s. Now, the big question we all know is the E. We don't know what the E is, but I do suspect that, in times of high uncertainty where there's still going to be huge demand for AI and productivity, that you'll see some money rotate back into these names after they've just gotten walloped here the last few months.
Keith Lerner, thank you so much.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Joining us now, surveillance right-sizing correspondent, Sonali Basak. There's like 8 ways to go here. We got James Dimon's letter. Forget about it. What's percolating out there is margin calls, and I would add to that the stresses of private equity or private credit. What can you report?
Well, let's do 2 things. On the margin call side, of course, these were the worst margin calls since the COVID pandemic. However, wire time's a little different now. You already had so much pain coming into this year that you had a lot of people hedging. You had a lot of rotation.
It's already cleared out.
A little bit of it. Okay. I mean, not to say there won't be more, but when I talk to the banks, even at the highest levels, yes, there's a little bit of panic in the sense that they are really screaming, hoping for the president to roll back, right? I mean, hope is not a strategy, as we know. But, hedge funds at this point, I would also say, remember, there is an element of excitement too, Tom. Last night, I had tons of fun saying, the cash has been working as a good hedge, which means they also have cash to deploy when things get really bad. So I think there is equally an element of waiting for that really bad to start to step in.
Will you let us know when that happens?
Yeah, 100%. I will be crying to come on surveillance radio, of course.
Now, I've seen just on social media, a lot of the big names on Wall Street, Bill Ackman, for example, has been very active. And Capitulated. I mean, he's been such a supporter of the president and the president's economic policies, but I think even he has said, all right, we need some clarity here.
Yeah, to Tom's point on the private markets too, equally people who have been deep into public markets are actually more worried about private markets because you can't see how much pain is under the surface. There have been years.
But Shonali Bassett can.
A little bit. Why can you? Because on one hand, you have a sense of sky high, more than a decade worth of bankruptcies last year. If you can think about how much pain you saw coming into this year, then multiply that by a lot.
Okay, but Paul's been on top of this. Private credit. What is the worry about private credit? Describe. Is it they're locked in? What's the angst?
Have you heard of this term amend and extend?
Yes, of course. Right. On the lending side, yeah.
So,
Rich, did I hear that from a divorce lawyer once? Okay, thank you. Continue.
Amend and extend, amend and pretend, if you want to call it that. People have put on so much debt on their balance sheet to get through the last couple of years because the IPO market has been closed. The M&A market hasn't been open to a lot of these highly levered companies. The moment was supposed to be now, Tom.
I'm shocked.
They were supposed to sell now.
You're right.
They can't sell.
You're right.
They can't sell.
They're locked in.
Correct.
Paul, what's it mean?
I'm going to ask Shonali, what are I see the big Wall Street firms cutting their price targets. I mean, the Wall Street's jumping.
And that's just in public markets.
Yes.
So if you look at private markets, you're looking at values that are declining steeply. You're looking at leverage that is a turn, two, three
there's
more.
There's leverage there?
There is leverage there.
Okay.
And as you know, leverage is the enemy.
I got 1 minute left here. Just as simple as I can. Mr. Diamond's out with a letter, and his defense was written before all this idiocy. Are we going to right size? I mean, I'm making jokes about, and folks, I hate the phrase layoffs in finance. Are we going to see firings to right size to a new reality?
It's certainly becoming a discussion because all the deals that were expected to happen, it's already April. You can count out the month already, how much is actually going to happen this year.
Right.
You're not going to see the activity come back in full form.
Right.
And honestly, bank earnings start Friday, so you'll hear the weather report.
Thank you. I lost my mind on that. How are the international banks doing in Manhattan now? The Deutsche Banks, the BNP Paribas.
HSBC is one of the most interesting to watch. They are on the tail end of a massive, maybe historic for the bank restructuring. They got rid of a lot of businesses, and now they're focusing on things like trade financing, which is, for this market, a pretty interesting place to be.
Okay. What do you want? I got 10. What are you watching today? What's the number one thing?
Credit spreads.
Well, like high yield, full faith in credit?
High yield, investment grade, credit default swaps. Remember, credit is that canary in the coal mine. And the smart money watches the credit go first.
Is a canary dead, Paul?
Yeah, I don't know. Gasping for breath here.
Shonali, I love busting her chops. Shonali Bassett, and I really want to do a massive shout out to her leadership on Bloomberg Invest this year. Was a high point.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.